Good evening, boys and girls. My name is Mr. Main. I'm here to introduce a new topic that is called income statement or profit or loss structure. Profit or loss, it is a statement that shows how a business has made a profit or loss during the process of what? Of buying and selling. So income statement, it firstly shows with sales. Sales, these are goods that have been sold to customers by the business. That is why we first record sales, which means the income statement, it is a statement that shows a business is making a profit or loss. So we start with the sales, which means these are goods that have been sold to our customers. As we look at this statement, we are a business, and on the left hand, they are our customers. So which means if we sell our goods, we are going to record that amount to the credit side. On the next video, I'm going to show you how or the structure of an income statement or the format of the income statement. This is only a brief explanation of an income statement. So we first start with the sales, then second with the returns inwards or less returns inwards. Returns inwards, these are goods that have been retained by our customers with the purpose of perishable, with the purpose of expiring date, with the purpose of broken things, unfortunately like glasses, or water glass, and so forth. So which means the answer we are getting there, that is called a turnover. Which means after that we are going to record less cost of sales or less cost of goods sales. Less cost of sales, we start with opening inventory. Opening inventory, this has been shown by by dates. The difference between closing and opening, it is by dates. Opening inventory, it is the beginning. It is the beginning inventory. For example, if we say we start our business on 1 January 2025, so which means our opening inventory should be start on 1 January 2011, that is an opening inventory. So which means our closing inventory will be 31 December 2025. That is the only difference. So in income statement, we firstly record in opening inventory, which which shows the inventory or the stock that wanted to be sold during the course of the business. Which means we actually say we first with sales, less returns inwards, we get turnover, then we go to less cost of sales, then we go to opening inventory. We add another transaction, that is purchases. So which means opening inventory plus purchases, we get an amount that it's actually not have a name. So after that, we will deduct returns outwards. These returns outwards, these are goods that we have return those goods to our suppliers, which means these are returns outwards and they are returns inwards. So returns outwards, we are going to subtract it from what? From purchases and opening inventory, which means after that we are going to subtract also closing inventory in order to have our total cost of sales, which means cost of sales, it actually consists of opening inventory and purchases, less returns outwards and less closing inventory. That is a cost of sales. So which means sales minus cost of inventory, we will get gross profit. After that, we will record every income that have been received in what in the course of the what of the business. For example, commission received, discount received, and so forth. The any income that had come during the coursework of the business, it will going to be added on what on gross profit, which means after gross profit we are going to look on expenses. Expenses, these are costs that had been incurred by the business during the what the cost period of what of the business. So which means expenses consist of electricity, uh, light and heating, depreciation, increase in provision for bad debts, salaries and wages, and so forth. So which means gross profit minus expenses, we will get net profit. If expenses are higher than gross profit, which means we are going to get what? A net loss. So actually the template of the income statement, uh, it will start with sales, then less returns inwards, we will get turnover, then less cost of sales, that will consist opening inventory, add purchases, less returns outwards, less closing inventory. We'll subtract these from the turnover that actually give us the gross profit, which means gross profit minus expenses, we will get what? We will get net profit, which means turnover or sales minus cost of sales, we will get gross profit. After that, gross profit minus expenses, we will get net profit or net loss. So that is the template of what? Of income statement. Income statement is simple, like eating salsa with okra. So on the next video, I'm going to show you an extract of the income statement, the extract of the income statement or profit or loss income, that will show you how to understand, to get deep in accounting. Yeah. So accounting is about recording financial transaction in the what? In the books of accounts. That is what we call accounting. So income statement, this is the simplest thing, but it is actually an important thing. In what? In accounting. That is the first thing you must know. Income statement. Yeah. So income statement, there's someone that had been asked about how to calculate depreciation. We will look about that after that. Depreciation, we actually have examples like a straight line method, reducing balance method, revaluation method, and so forth. So this is a template of income statement. Thank you. Follow, like, and share. Thank you very much.